Okay, let's pick up where we left off here. And we issued the bonds. Now the other thing we have to do is pay the interest on the bonds. So we're going to pay the interest, and this is generally semi-annual. If we issue the bonds at a discount, this is going to add to our interest expense over the life of the bond. And if we issued the bonds at a premium, that's going to reduce. We'll use the extra money we got to offset that interest, so that will reduce the interest expense over the life of the bond. So I'll show you how that works. If I issue the bond at face value, I don't have to worry about it. When it's time to pay interest, I debit interest expense and I credit cash. Let's pretend it's $50. And those two are the same, and that's fine and dandy, and we're all set. If this bond was issued at a premium, I'll debit interest expense and I'll credit cash, but I get to kind of reduce the cash. So I still have to pay whoever holds the bond. This is based on the stated interest rate. I have to pay them that. But I'm going to credit this. Remember back here, I credited premium on bonds payable. So I'm going to take that total amount and I'm going to use that to offset the interest, to reduce my interest expense on this bond. But I'm not going to do it all at once up front. I'm going to spread it out over the life of the bond. So every time I make an interest payment, I'm going to take part of this premium and I'm going to credit. That's the amortizing the premium, spreading it out over the life of the bond. So I'm going to kind of take this full premium and I'm going to reduce my interest expense as I go. So each time I'm going to take a little part. So this was a credit to start with, so I'm going to debit it. And every time I do this, it's going to bring that down a little bit. Let's say this is $5. So the interest expense is only $45. And I'll do that every time. Premium on bonds payable. So that by the time I get to the end of the bond, the premium's all gone. The balance in premiums is down to zero. It's the opposite if I issued this at a discount. Then my interest expense is actually going to be higher than the cash I'm paying out, because I'm going to take that discount that was initially a debit and I'm going to credit that part of that. And I'm going to do this every single payment on bonds payable. So let's say that was $7, but I still have to pay the whoever has the bond. I still have to pay cash of $50. So now my debit expense is actually $57. It's higher. So for it's a premium, the interest expense will be less than the cash, and if it's a discount, the interest expense is going to be more than the cash. All right, so let's look at one here. On this one, Ogden issued $70,000, 12%, 10-year bonds payable at 90 on January 1st, 2016. So at 90 means they issued it at a discount. That means the cash they got up front when they issued the bonds is less than the amount they're going to have to pay back. Basically, they got 90% of the cash. So we're going to issue that, and then we're going to pay interest. So when we issue the bonds, I'm going to debit cash. I'm going to debit discount on bonds payable. And I'm going to credit bonds payable. That's the actual liability there. So I know that the credit to bonds payable has to be for the face value. That's the $70,000. But I'm not going to get $70,000 up front, right? I get something less than that. So $70,000 times 0.9. They issued it at 90. 0.9 means right now I'm getting $63,000. So the cash that they receive at issuance is $63,000. The cash they'll have to pay back at maturity is $70,000, and the difference between the two is the discount on bonds payable. Now when I pay interest, I know I'm going to debit interest expense, and I know I'm going to credit cash. Let's do the cash first. So the cash, so this determines the discount. This 12%, that determines the cash that's paid. So $70,000 times 12%, and this is a semi-annual payment, so 6 months over 12. So I'll take the 70,000 times 12 and take half of that, which means the cash that I have to pay is $4,200. Now let's go back to the $7,000 discount. The discount is $7,000, and I'm going to pay, I'll just take that off, 10-year bonds, and I'm paying twice a year. So I'm going to make a total of 20 interest payments on this bond, twice a year for 10 years. So I take that $7,000 discount and I divide that by 20 payments, which means each interest payment I'm going to amortize 350 of that discount. So that's what I'm going to credit on discounts on bonds payable. Discounts on bonds payable. It started with $7,000 in it. Now after my first payment, I'm going to credit it $350, so it'll come down, and then these two together are my total interest expense. So I'm writing a check for $4,200, but my interest expense is actually $4,500, and I'll do that 20 times. So at the end of that, I will have recorded the interest of the 12% every year, but I will have also added to that interest expense the entire $7,000. I'm just not going to do it all at once. I'm going to spread that $7,000 over 20 payments to add to my interest expense. And remember, the reason I had to offer a discount was because in this case, this was a 12% bond, so the market rate must have been something over 12%. That's why I had to sell it at a discount. So when I add this $7,000, I'm kind of bringing it up to whatever the market price is. So that's why I added into the interest expense. Let's do one that is a premium. Watson Mutual Insurance issued a $65,000 11% 10-year bond payable at 109 on January 1st. So we'll issue the bond first, and we can see that we're going to get something more. It's over 100 here, so it's a premium, right? So on January 1st, I debit cash. The amount of cash I get will be the face value, 65,000 times 1.09. That's the 109. So the cash I'm getting is 70,850. 70,850. The credit to bonds payable will be the face value of 65. So to make my debits equal my credits, I clearly need something over here, right? So 5850, the difference between the two, is the credit to premium on bonds payable. So I'm going to do the same thing that I did with the other one. I'm going to take that 5850 and I'm going to spread it out over the interest payment. So it's a 10-year bond, and I'm doing semi-annual payments. So I'm going to take that 5850, the amount of the premium. I'm going to divide that by 20 payments. If this was a 15-year bond, you'd be dividing it by 30 payments. If it was a 10-year bond that was just making annual payments, you would divide it by 10. So just the number of interest payments you're going to make. And so that means the amortization is going to be $293 per payment. But it'll be the opposite of the discount. So this has a, we started out with premiums of a credit balance, and I'm going to chip away at that over the life, so that means I'm going to debit it each time I make an interest payment. So my first payment will be on July 1st, so I'm going to debit interest expense. I leave that here because that's my debit, but I'm going to fill in the amount later. So then I want to debit premium on bonds payable for this $293, and then the cash will be based on the 11% interest. So 65,000 times 11%, and then we'll split that in half because it's a semi-annual payment. So the cash I have to pay is $35.75. The interest expense then will be the cash paid minus the portion of the premium that I am taking, the amortization. So the interest expense is $32 $1,082. It's lower than the cash because this is a premium. I guess this is probably the last thing I want to show you here is retiring bonds. So when I retire the bond, if I hold this bond all the way to maturity, that means there's no balance left in either the premium or the discount. This would also be the same if it was issued at face value and I didn't have to worry about a premium. All I do is the opposite of what I did when he issued the bonds. I'm going to debit the liability of bonds payable. I'm going to credit cash because I'm paying it back. And this would be for whatever the face value was. And that should be all that's left if I carried it to maturity. So on this example, and these that I'm doing are in the demo problems that you have in my lab. So Deere issued $125,000 of 6% 15-year bonds payable. We're going to journalize first the issuance of the bonds at face value. So that means there's no discount or premium. So I would debit cash, and I would credit bonds payable for $125. And then they want the first interest payment here. And really, once you figure out one interest payment, they'll be the same every single one, whether you're doing 20 or 30 or however, every single one will look exactly the same. So for the again, there's no discount or premium to amortize, so I'll just debit interest expense and credit cash. And this will be for the face value times the interest rate. And it's semi-annual, so we'll split that in half. So I get interest of $37.50, and a credit to cash for $37.50. This is a 15-year bond payable, so I would repeat this step B 30 times. And then at the end of that, the maturity date will be, we'll take January 1st, 2016 plus 15 years. So it'll mature on January 1st, 2031. So it'll just look like the opposite of A there. So that will be a debit to bonds payable, and I'll pay back the cash of $125. Sometimes, though, bonds are what we call callable. So if the bond is callable, that means the person who issued the bond, the debtor, the person borrowing, can pay it back before the maturity. Can pay back before. Now, obviously there's a lot of reasons they might do this. If they have cash and they want to pay less interest, get out of the interest payments before maturity, or if the rates have gone down, and so you've got bonds out there at 10%, and the rates drop, you might make a new issue of bonds and use the cash you got the VAT to pay that back. So you still have the same amount of debt out there, but your interest payments are smaller. So if you're calling the bond before maturity, you need to calculate the carrying amount of the bond. And this will always be, the carrying amount is always the face value of the bond plus any non-amortized premium. So at first, when you first issue the bond, that's the entire premium, right? But if you've made 3 years worth of payments, and that's come down. Every time you made one of those payments, you brought that down a little bit. So it's basically whatever the balance is on the premium account, or the face value minus any non-amortized discount, whatever's left in the discounts on bonds payable. And in some of the problems, you have to keep track. You have to go back and say, okay, you have to go all the way back to the beginning of the problem, or even if they didn't ask you that, and say, all right, when I issued it, I had to say, here's what it is, and here's how many payments it's going to be, and so this is what one amortization would be, and then figure out how many you've done to figure out what the remaining balance is in that. And then you can figure out the carrying amount. And then the carrying amount minus whatever the market value is equals the gain or loss on the retirement of the bonds. So this is what you had to pay to retire it. And sometimes you have to pay more. So this is essentially what it's worth now. The carrying amount is what it's worth. And this is the cash that you paid to retire it, all right? And then the difference would be the gain or the loss. So let's just figure out one of those. On this one, Patel issued $40,000 of 7% 5-year bonds payable at 109. So they issued that at a premium. Patel has extra cash and wishes to retire the bonds a year later, immediately after making the second semi-annual interest payment. To retire the bonds, they pay the market price of $95. So this is the cash paid to retire. That's this one right here that we were talking about. So the carrying amount of the bond at the retirement date. So we figure out at the beginning the total premium is hold on one second here. Sorry about that. Okay, the carrying amount of the bond. We have to go back at the beginning and say, okay, oops, let's put the pen back on. The bond was a $400,000 bond, and we issued it at 109 times 1.09. So that means the cash we received was $436,000 when we issued it. Cash at issue. So that means what the cash we got minus the face value, the premium on this bond was $36,000. So if at the beginning then they would have said, okay, we had a $36,000 premium, and this is a 5-year bond with semi-annual payments. So 5 times 2, so there'll be 10 payments, right? So I take the total premium, $36,000, divided by 10 payments. So that'll be $3,600 is the amortization amount per payment, per interest payment. And I would have done that twice, right? So the total premium is $36,000, and then after the first payment, I reduced that by $3,600, the first interest payment, and then the second interest payment, I reduced it by $3,600. So now the remaining balance is $28,800. That is the non-amortized premium. The amount that's the remaining, that's the balance in premiums after I've made 2 payments, after I've made 2 interest payments. So therefore, the carrying amount of this bond is the face value, which is $400,000, minus the $28,800 that's left. So the carrying amount is $428,800. That's essentially what this bond is worth right now. To retire the bond, they paid the market price of $95. So the second part says how much they have to pay to so this is part 1. Part 2 says how much do they have to pay to retire the bonds payable. So what they have to pay is the $95. So that'll be $400,000 times 0.95. So that's $380,000 cash at retirement, whereas this was the cash at issue. So the difference between basically what they paid to retire it and what it's worth, so the carrying amount $428,800 minus the market value, or what they paid to retire it, means they they had to pay less than it's worth, so they had a gain of 48.8 is a gain. I'm gonna I'm gonna add one little slide in here, just kind of a blank one, because the problem related to this seemed to give my in-person people the most trouble. So just to kind of show you the journal entry for recording that, I always fill in, so you know you're gonna journal entry to retire that before maturity. Oops, before. That's terrible. I'm sorry. And now the cat's helping too. I'm sorry. So I'm going to debit bonds payable for the face value. I always fill that one in first because you know that's going to have to be for the face value. So I always do that one first. Then I jump down to the, in my lab how they give you a couple different rows. I jump down to the bottom and do the cash. And that's, like in this example. Oh, let's use this example. That would be helpful, wouldn't it? So in this case, the face value was 400,000. Sorry, I don't have room on just to put it all in there for you. So that's 400,000. That's the face value. And then down here, I fill in. Oops, wrong one. The cash that I paid to retire it. Okay, and that's what we did. That's the 95, right? So the cash paid to retire it. I think in the homework problems, it's generally you paid more to retire it, so it's something greater than the face value, but the process is the same no matter what. So that was 380, right? 380. Then the other thing you have to do is take care of whatever's left. In this case, we had a premium, right? So the remaining balance in premiums are credits, right? When we issue the bond, we credit the premium on bonds payable. So then I want that to go away. So I'm going to debit that for the full balance that's remaining in there, 28.8. Just keep going the wrong way. So 28.8, I'm going to debit premiums on bonds payable. So I do, because you would have already had to figure out how much is left in there to figure out the carrying amount. Okay, so I fill that in. If it was a discount, then you'd be crediting that to make it go away, because a discount would have had a debit balance, and so I want to zero that out because the bond is gone. So the discount of the premium that goes with that bond also needs to be gone. So I do that one third. Again, that's the remaining balance that you had to figure out in order to do the carrying amount. And if that was a discount instead of a premium, that would be a debit. And then the fourth step I do is figure out the gain or the loss. In this case, we said it was a gain of 48.8, and so gains are credits. 48.8. Gain on retirement of bonds. And so that's the fourth thing I fill in. And then the fifth step I do is check to make sure debits equal credits. So this is the, again, this is the cash paid, so this is the market value. This is the difference between the carrying amount minus the market value. And then this is the remaining balance in that account. If it was a loss instead of a gain, then that would be a debit. So at this step, if it's a premium, you want to debit. If it's a discount, you want to credit. Again, you're trying to zero those out. And if it's a gain, that's always a credit. And if it's a loss, that's always a debit. So Hopefully that helps. That was a little bit of a mess there, but hopefully you got that one. Let's see. The last two sections on here are kind of about where these fall in. So we're going to take the balance sheet, we're going to split up. So we've got current liabilities and long-term liabilities now. These guys are all those payroll things that we did last semester in Chapter 11. And then let's talk about the long-term. Oh, let's talk about this. So these long-term notes payable, the thing that we did, the first thing we did in this chapter, those are things that are going to be due over, 5, 10 years, something like that. So we split that out. So right here we've got notes payable of $15,000, and then we have the current portion of long-term notes payable. So these two are really one note. And I just say this much of it's due in the coming year and the rest of it's due later. And you've got the same thing with the mortgage, right? This mortgage payable and current portion of the mortgage payable are really one thing. I just say how much of it's due this year, and then the rest of it goes into the balance. And then here is our bonds payable that we've just been talking about. So this will be the face value of the bond right here. This will be the remaining balance in discounts, or we would add premium if it was that. And so the bond minus the face value minus the remaining discount means that this is the carrying amount that we were just talking about. And so then you've got total current plus total long-term equals total assets. And so nothing earth-shattering there, but just to see how what we've been doing fits in with the balance sheet. And then the last thing I wanted to talk about, well, that's odd. PowerPoint seems to be acting a little funny on me here. The last thing is just about kind of some analysis and decision making, and this looks really weird, so I'm just going to talk here for a second. But just financing through debt versus financing through equity, and it kind of talks about the pros and cons of here. I don't know what this is going to look like when I save it. So the debt to equity ratio is total debt divided by total equity. I'm afraid if I erase this right now, it's going to erase it off the other one. I don't know why it's in 2, but well, let's see what I get. It's acting a little strange, and I don't want to start over because it's taken forever. Sorry. If this debt to equity ratio is greater than 1, then that means this company uses more debt financing. If it's less than 1, that means they use more equity financing, which means more debt financing means when they need to raise additional money, they borrow it or issue bonds. Equity means they're issuing stocks. So there's pros and cons to both, and they impact a lot of things. The interest rate on the bonds serves as a tax shield because it increases expenses, and so that decreases net income, and they're taxed on their net income, not their revenue. There's that risk versus return that we talked about a little bit earlier. Meaning, again, you have to pay it back. There's something called leverage, which is how much debt you have. The more highly leveraged you are, the more debt that you have. And leverage tends to amplify things. So if things are good and you're highly leveraged, that makes it great, like a profit. But if things are bad and you're highly leveraged, that makes it awful. So it amplifies that profit or that loss either way, good or bad. It makes it more. So when things are good, you're on the return side, but you've also got that risk when things are bad. Also, if you're highly leveraged, that can affect your ability to borrow, because somebody might not want to lend you more money or buy your bonds if you have a lot of debt. And if you're issuing more stock, that can affect your stock price, right? Because the more shares that are out there, it's supply and demand, that'll bring down the stock value. So there's a problem in the end of the demo problems where you can kind of compare it's a company that needs to raise $3 million, and what does it look like? And what you end up seeing in that one, if you haven't done that, is when you finance through equity, it increases the total net income, and so that's great. But because you're doing it through more shares, even though the net income is higher with that one, the earnings per share is higher with the debt one, which is why investors or stockholders will actually rather see more debt financing. Whereas if you're just worried about net income, you might rather have the equity financing. So there's a lot really to consider in there. All right, so there's chapter 14. Let me know if you have questions.